the food area.
You smell the fish.
No, I don't like the food there. I think I'm just going to drink more tonight. There was no one when it goes.
Nevin's like, you want to walk around?
Yeah, I mean, I found a couple of good Cubans, two guys, they came friendly, I got their phone number, and they touched it. So, when I go this time, I already told them, we will come pick me up and we'll take care of it for like 20 bucks a day. So, yeah, what's the total, maybe not enough, but probably there's no difference in making $15 for salary. Female makes $10 a month, male like the police officers, their salary is $45 a month, and they're high salaries. But then when you go even when you're signing Mexico has some rules.
The owners, for 20, we can't include it, like 12 days. But I think the factor, right? How much?
Follow up, change it.
That's totally your call. I think it's kind of judged by profit
Right.
that you want to ultimately make on the property. Necessarily having to take ownership of that.
Yeah, because I guess I'm trying to, my brain, I'm trying to rationalize it.
Yeah, no,
My cam portion, I take care of my OPEX and stuff like that. But then I know those other things, like I gotta factor in, my principal portion of the mortgage, the funding, any other capital improvements and stuff like that. So obviously I deduct that from my base rent amount, and sustainable, so I'm good there. But is there for any kind of margin to say, hey, don't ever go below
It
this?
depends on how strong the market is. That's really what it boils down to. If you've got a really weak market and there are tons of tenants chasing space, then you're going to have to give up on it.
So I'm in a weird spot because right now I'm at 86%, but right down the street from me in the corner, Adler just bought that whole center. They're redoing the entire thing. I mean, it's almost, they're refitting the entire center, so it's going to create.
Visual contrast.
Yeah.
Okay, let's go ahead and get started. So the plan today, this is if we go ahead and get through chapter 14, dealing with disposition and renovation of income properties. After we finish this, then we're going to go directly into test number 1. You'll have whatever time we have left over to do test number 1. Test number 1 is 30 questions. So there's no question that you're going to have at least 2 hours to work on that, okay? So more than likely we'll do an hour, hour and a half, maybe 2 hours at the absolute maximum on this material, and then you'll still have the 2 hours to work on the test, okay? And just out of curiosity, how many of you are planning on taking the test? Okay, so the majority. Okay. All right. So the topic for today, dealing with renovation of income properties and also trying to make disposition decisions. So most of what we're going to be dealing with today, much like a lot of the other material in the courses I teach, tends to be very quantitative, tends to be very much based on the kind of the financial situation of the property. And but we'll also talk about some practical issues that are going to pop up as well. But one of the things, whenever you're, I guess, evaluating whether or not you're going to keep a property, or you're potentially going to renovate it, or you're going to sell it over time, is to sort of take a look at how much money you have wrapped up in this property in total. And what that basically refers to is your equity buildup, okay? Now, how many of you have heard that topic before? Equity buildup. All right. So the idea behind equity buildup is this is the total amount that you have put into the property, both in terms of a down payment as well as your accumulated principal payments. Okay, does that make sense? Because think about it like this. You buy a property, you hold it for, let's say, 5 years. During that 5 years, you're paying down part of the mortgage balance, yes? So in essence, that's additional equity that you're really contributing to the property. Now granted, the property itself is really paying for that equity buildup. In other words, the property itself is the one generating that sort of payoff amount, but at the same time, you need to keep that in the back of your mind pretty much at all times. You know, do you get to a certain point of where the equity is built up to a certain level that you may say, hey, I need to pull some of that equity out of there and put it to more productive use, okay? And, or, you know, I might build up so much equity and this property is at the peak of the market, now maybe is the best time to sell it, get out from underneath it, cash out of that equity, hold on to that equity for a period of time before maybe jumping back into the market in another property. Does that make sense? Okay? So at any given time, you need to kind of have a good clue as to what the equity buildup amount really is. So, let's just take the property that we have purchased. They give me a dollar amount for the property. $15 million. Was our original purchase price. Now, of that $15 million, obviously part of that we're going to put in as a down payment, part of it we're going to borrow. So, what our loan to value ratio? What do you want? 75% loan to value. Okay. So $11,250,000 is going to be our debt. All right. The remaining 25%. Or $3,750,000 is going to be your equity. Okay. Nothing new there. Now, real quickly, just to make sure that you're following what I'm saying. So at the time that we buy this property and we have initiated this loan, what is our current equity buildup? $3,750,000. Okay? Everybody cool with that? All right. Now, let's say that we decide to potentially evaluate our position several years into this. Okay, so let's pick a number of years. 7 years? Okay? All right, so what we're going to do, first of all, 12 payments per year, and we're going to take our debt, okay? We said we're going to go 7 years into this, so, oops, 7 shift in. Okay, now we haven't even talked about what's our interest rate on this loan, okay? So give me an interest rate. 5%. Okay, so now that we've got the loan terms, the loan amount, the number of years that we're going to be, well actually in this case, let me back up.
That should be the
Yep.
long term.
That's the number of years, 7 years is the number of years that we're going to be looking at. The total loan term itself is, let's say, going to be, I don't know, 25. All right? So 25-year loan term at the 5%. And so we're going to start off, and we're going to get our payment. And so, looks like we got 65, 766, and then 38. Okay. Now, this is where we're going to incorporate the 7 years. So we're going to do one input. Now, 7 years times 12 months in a year, it's going to be 84 months. Do the shift, amortization, hit the equal key. And we should end up with 1,895,346, 347, somewhere in there, okay? That is the amount of principal that we get paid off. Everybody cool with that? Yes or no? Okay, so now if I asked you the question, after 7 years, what is my total equity buildup? What would the answer be?
What is the one you get?
You're going to add those two together.
Mm-hmm.
You're basically going to take the 3,750 and add it to the 1.8 million, okay? Okay, so let's do that. Okay, so once again, our total equity buildup is going to be that. Okay, now, that gives you enough to help you to solve the question on the little quiz and that sort of thing. So let's talk about some of the other issues, more practical issues as it relates to this. This makes the assumption, let me see if you figured out. What would be one of the assumptions that you're going to make with this that may or may not be a realistic assumption 7 years into this?
Your sales price.
Okay, your sales price in what way?
You should be able to sell it for higher than.
Okay, or that you're going to sell it for a different sale price potentially than what you paid for it. Okay, because you would think after 7 years your price is either going to go up or it's going to go down. Okay, or the market value, if you will, is going to go up or it's going to go down. But if the market value has stayed the same, this truly is the amount of equity you have in the property. Yes. But let's say the property has gone up in value. No, let's say it's about another 5 million, that you could sell it for 20 million. So your real total equity would be this plus an additional 5 million bucks. Does that make sense? So then you begin to say, wow, maybe I need to really think about selling this so I can cash out some of that equity, or maybe I need to think about borrowing against this property, either refinancing it or borrowing against it. Now you're giving me that look, why would you want to do that? Why would you not just want to go ahead and potentially carry on and pay it off? Well, that's another strategy as well. It's just a question of how active do you want to be as an investor, okay? Because the typical real estate investor, for better or for worse, is always going to be chasing deals and looking for basically the next best opportunity to put their money into and to maximize the ability of whatever borrowing capacity that they have. Okay? And what I mean by that is if all of a sudden, 7 years later, we said this property is maybe worth 20 million bucks, and you've got already this amount of equity plus the 5 million, which we're talking about, you know, having a little over $10 million worth of equity just sitting here, would you maybe not be better off saying, okay, I want to refinance this whole thing just take that as an example. So let's say that it is now worth 20 million. And we're saying that we've got basically 10 million, 5, 6, oops. Oops. Yeah, 645. 347 as our total equity. Okay, so if we just simply take that, and the amount of debt that we technically have left is about 9,354,653 remaining debt. Well, that represents, if you sort of just do the simple math, if the value now is 20 million bucks,
That's 645 or 545 on the second.
645. Oops. All right. So basically what this is saying is we've got roughly, at current market conditions, without refinancing, that we're sitting somewhere around a 47% loan to value ratio. Now the lender loves that. Okay, the lender is loving that because they're saying, you know, in the event that anything were to go wrong, there's more than enough value tied up in this property to be able to satiate whatever demands the lender's going to put upon you. But you're saying, or you should be saying, I'm leaving a lot of money on the table if I'm allowing that to happen. You follow me? Because if current conditions are that you could also get a 75% loan to value ratio again, then what you're saying is if the value of the property is now $20 million and you can get 75% of that, that means that you can get $15 million in debt, okay? Well, you've currently got $9,354,653, so this is maximum debt, and this is current debt. That means that you've got an additional borrowing capacity of about 5.6 million. Does everybody understand that logically? Yes or no? Okay, so now, if you just think about that just in isolation, just for a moment, if you wanted to, you could simply say, all right, if that represents, in one sense, equity, but I could basically throw into another deal by virtue of refinancing this debt. Do I follow me on that? If I can convert this basically into new equity, then if that represents basically 25% of a total deal, you could take that divided by 0.75, or sorry, 0.25, and that means that you could finance a project around 22,581,000. So you could finance basically another project greater in size than your current project. Does that make sense? So you could double the fund, so to speak. All right? So I follow that. Yep.
If you sold it and you pulled your 10 million out, you have more leverage. I mean, you'd be able to do probably double that size. With 10 million, you should be able to get $40 million worth of the 75% loan value.
Okay, one more time.
So if you sold, instead of refining, if you
Okay.
sold it at your 20 million, you'd be able to pull out 10 million. So wouldn't that be a better?
Well, so what we're doing is we're basically saying, all right, we're refinancing it at the same sort of loan to value ratio. So there, our maximum debt is gonna be this, but we've got this current debt, so this is the amount that we're able to completely pull out.
Right.
I understand what you're saying, that if we kept our original loan, we sold off that, then yes, but the problem is, you're still gonna have to, if you're being constrained by the 75% loan to value ratio, you're not gonna get any more, I can work it out mathematically, but you're not gonna get any more value in terms of your borrowing capacity, unless I'm missing something.
Well, I'm just saying, because you would end up, if you sold it, you would end up with 10 million.
Yeah,
You know what I'm saying? So 10 million your leverage.
Right.
With
Yeah.
with 75% LTV.
In 7 years, it
Yeah,
might,
you'd be able to do a deal for 40 million, let's say. So I don't know, I'm just trying to figure out what's the better use of the leverage.
if I have a deal that after 7 years has gone up, you know, with 25% or whatnot,
What would it say?
then that's a good performing asset, so I'm gonna hang on to
Yeah.
that. It's more expensive to sell off a property and buy a new one than it is to refinance one and then buy a second one.
Correct.
So you have more money, more working capital instead of just paying a lot more expense.
And the asset
So,
appreciation.
yeah, I mean, and now the asset's performing, so then, you know, if you have, then you're diversifying your portfolio instead of counting on one, you have one good solid one, then you take the risk with a new purchase.
Yeah, but, okay. good.
Or you take all your cash out and you have $5 million and you have nothing in the property. And it just cash flows itself. So you're at zero basis now, right or
Yeah.
wrong?
No, like,
Then you got an asset paying for itself, so you take your $5 million and,
yeah, what's the fun in putting the money in a savings
And
account?
see,
no, what I'm saying is you're out.
Right.
You're out of the deal. This is done every day with apartment buildings, doing what he says,
Right.
but you're out. So you got a cash flowing and it's going up and, you know, your rent rates are going up, so basically you're at zero. What's the return on zero? Infinite.
Yeah, but if I,
yeah, so, I mean, my point with this, there are multiple ways you can approach it, okay? In terms of whether you cash out, whether you stay in, whether you basically refinance, you know, that's part of what we're exploring here, okay? There's no one absolute
right.
perfect solution, okay, for every single scenario, all right? Because part of it may also be your tax structure. You may be in a situation where you do not want any capital gains, or you may not want any sort of additional income at present because you've got a bunch of other additional income that you really don't want to potentially go up in your sort of marginal tax rate. You know, so there's a lot of different swirling issues here. All I'm trying to point out with this is simply to say that with the property going up in value, with your equity buildup, you can, in essence, under this scenario, after 7 years, basically pull out this money and use that to fund another deal of basically the same size. Okay, that's all we're really trying to explore here. Okay? Okay? All right, any other thoughts, questions, observations? Now, one of the other things I want to point out, though, is, you know, by pulling out this equity, you know, we're re-levered back up at the 75%, whereas we were at 47. So in the event of a market downturn, where rents might go down, occupancies might go down, that sort of thing, we're more susceptible to, obviously, the cash flow not being necessarily sufficient to be able to pay off that debt. Okay, so that's another piece to it.
So would you say the strategy would obviously change based on market conditions?
Oh, absolutely.
How you would have to
Absolutely.
evaluate it separately.
I mean, and every investor is different in terms of how they view this sort of stuff. I mean, some investors, you know, are clearly of the mindset, let this sort of happen, and just simply let the money continue to be in there, and if I really don't have any other alternative investments that I'm really wanting to explore for whatever reasons, just let that thing pay itself off. And where it's going to be just a free and clear cash flow with no additional burden. Okay? But if you're trying to a certain extent to do what I would call empire building, then you're going to want to try to probably pull some of that money out to be able to reinvest into, you know, something else. I mean, you know, to a certain extent, it's a lot like a business, because real estate is a business, but it's a lot like an operating business in the sense that you could, you know, for every dollar that you generate with like a retail store, you could come in, plow that money directly back into that same business, you know, modify it, improve it, make it, you know, somehow better. Or you could get the strategy of saying, okay, we're just gonna let this business operate the way it's been operating. Let's take that extra free and clear cash flow, go buy another business, and build it up. Okay? So it's just, it really kind of just comes down to what are your preferences. All right? And what is going to be the rate of return that you're going to generate on it. All right? All right, moving forward. All right. Let's see the next little topic out here. Okay, one of the things that your text talks about, take a look at this. This is on page 466, 467, where they're dealing with reinvestment rates, marginal rates of return, that sort of thing. I'll draw it out. You don't really have to look it up. I'm just going to. Okay. So basically, we've got time over here on the x-axis and the y-axis. We've got a return. Okay. Now, in the first instance, we've got a return percentage, and the one that they actually use is like 15.5%. Doesn't really matter what the actual numbers are, but 15.5% is the return, and this is what we're going to be calling our reinvestment rate. And we're going to have our marginal rate of return for the property over time. And you're going to see it's going to kind of peak and then it's going to decline. Okay? I'm going to explain this just in a second. This is a fairly important concept. Okay, then we have this other model on the second page where you've got the reinvestment rate sort of going up, and then we've got our marginal rate of return. Okay, so again, marginal rate of return, and then this is our reinvestment rate. Now what this is meant to do, this is just try to conceptualize what we're sort of dealing with when we're thinking about optimal holding periods. You know, how long should we own an asset? Okay, what should be kind of a quantitative decision rule as to how long we own an asset? So what we've got to try to do sometimes is create these, you know, wonderful abstractions of reality that we try to put in a visual sort of context that we can maybe sort of better relate to and then kind of understand what we're trying to accomplish. All right, so in this first instance, we're making the assumption that as an investor, our reinvestment rate is staying constant over time, okay? That it's not going up, it's not going down, it's just staying constant. That means that we've got some sort of other investment opportunity out there that will constantly yield us at least 15.5%. So for this particular project, what we're looking at is what is the marginal rate of return each year, year over year, and how does it potentially change year over year, okay? And we're going to explain how you actually come up with those numbers and how it sort of works here in just a second, but right now, what we're sort of talking about with the marginal rate of return is for a specific project and saying that hopefully over time, you know, it's going to generate, you know, in its growth phase, a lot of operating cash flow, and it's going to have a relatively high market value in terms of the sale price of the asset. But over time, it's probably going to decline. You know, property's not gonna be worth as much. It's not gonna have as high of a performance level with regard to operating cash flow over time. And once it kind of gets to this point here, of where it crosses over the reinvestment rate, that's when we should get rid of it. Because now this property is not performing at the level of our reinvestment rate or our hurdle rate. Does that make sense conceptually? Yes or no?
Yes.
Okay. Now down here, it becomes a little bit more complicated, only because we have an increasing reinvestment rate. So that over time, we've gotten better and better and better at identifying other alternatives for investment, okay? So it's not, once again, the reinvestment rate is not tied to one specific project. It's tied to potentially a portfolio of opportunities that we have available to us at any given time. Now, chances are, in the real world, you're gonna have a very difficult time trying to actually figure out what that reinvestment rate may be in terms of if it's gonna be an ever-increasing nature. Thus is why most equity players simply set a hurdle rate. And they simply say, here is the magical hurdle rate that we need to get over. Once we've gotten over that, and once we're able to maintain that, we're good. If it ever drops below that, we need to get out. Does that make sense? Everybody cool with that? Yes or no? Okay, now let's put some numbers to it, okay? So the thing that you really want to be able to calculate is this marginal, just going to put it out here, marginal Now, what does that imply to you? Marginal, and those of you that have taken any sort of economics courses, what does that mean to you? The margin means sort of like above and beyond a baseline. You know, it's above and beyond, it's that incremental. Okay, would be another word for it, all right? So in this case, what we're doing is we're trying to say, all right, we buy a property, we hold a property, and then each year we need to make a determination of, is the return going up? Is the return going down? And by how much? So, as an example, so give me number of years that we've owned a property.
7.
Okay. All right. So if we've owned a property for 7 years, one of the things that we're going to have is after-tax cash flow. And we're going to have the after-tax cash flow from operations and we're going to have the after-tax cash flow from the sale of the asset, okay, or proposed sale of the asset. So what that means is, think of it like this. It really, well, so first of all, let me make sure, this is a point of departure from things that we've talked about specifically in the real estate finance class. Here we are dealing with after-tax cash flows, not before-tax cash flows, not net operating income. We're dealing with an investor-specific rate of return based upon their tax consequences. Does that make sense? So, what we've determined, let's say in year 7, is that our after-tax cash flow from operations, and this is the way that I, try to very simply explain this. It's kind of like you own an asset, and one of the examples I give is like you own a vending machine. All right, and each year you basically fill the vending machine at the beginning of the year, and at the end of the year you basically empty out the coin box, okay? And then you refill it up for use again, so to speak. And when you empty out that coin box at the end of the year, you take all that money that's there, you've got to subtract out, you know, the cost of goods sold, you've got to subtract out the taxes payable, and then whatever money is left over after you've paid everybody, including, you know, the tax man, is your after-tax cash flow from operations. Does that make sense to everybody? Yes or no? Okay, now, at the same time that you've emptied out that coin box and you've paid everybody all of their due, you're also saying, I can sell this asset now, okay? Now you're going to incur taxes on the sale. You're going to incur additional cost of actually performing that sale. But that is going to be a dollar amount that you're going to be able to estimate or calculate with regard to that asset. So let's just throw some numbers down. And let's say that the after-tax cash flow from operations is, I don't know, $10,000. And the after-tax cash flow from the sale is, let's say, I don't know, $120,000. All right? But subsequent to that, we want to look at year 8. Okay? Now in year 8, we could get more in after-tax cash flow. We could also get less, and we could get the same. Okay? But that's also going to determine what our marginal rate of return is. Okay? So let's say that our after-tax cash flow from operations goes up to $12,000. And that our after-tax cash flow from the sale goes up to $140,000. So now we have all the information that we need to calculate what is referred to as a marginal rate of return from one year to the next, okay? How much more of a return will we get if we wait this additional year to sell off this asset? Does that make sense? Yes or no? So we're going to get an extra year of after-tax cash flow from operations, so an increment there of about $2,000, and then if we, on the sales side, we're getting an extra $20,000. Okay? Well, right off the bat, clearly it's a positive marginal, rate of return. The question is, how much? Okay? So the way that you calculate the marginal rate of return here is you're going to take the latest year, okay, of the sale, which in this case is $140,000, okay, and you're going to add to that the latest year of the operations, okay, and then you're going to subtract out the previous year's sale, and then you're going to divide all of that by the previous year's sale. So the one piece of information out of this that you don't actually even use is that. Okay? Because what we're concerning ourselves here with is if we hold on to this asset for one more year, what is the total amount of new income that we're going to receive? We're going to receive, okay, 140 plus 12 would be 152,000. Yes? Yes? Okay, so 152,000 subtracting out 120,000 is going to be $32,000 of fresh money. Does that make sense? Yes? Down here. So 32,000 divided by 120,000. Or 26.7%. And that is going to be our marginal rate of return from one year to the next. Okay, is everybody comfortable with that? Now, Let's just see if you are. Okay? Let's go to year 9. Okay? Year 9's operations maybe is 11,000. And the value is now 100 and let's say 32,000. Okay? Want you to calculate what the marginal rate of return is from year 8 to year 9. Well, yeah, that's what I want you to calculate. Okay, we don't need this anymore. We'll do that. So all we're going to be doing is basically taking the 132,000 plus 11,000 minus 140,000 divided by 140,000. So it might not be completely negative, it's just going to be low. So you get 3,000 divided by 140,000. It's basically 2%, 2.14% marginal rate of return. So very quickly, we turn the corner in a bad way, all right, with this one. I mean, we're still getting a positive rate of return by holding it, but this is the point that I'm trying to illustrate. Assuming for this particular scenario that our reinvestment rate or our hurdle rate for us as an investor is 15%. Okay, what should we do? Sell. In other words, we should have sold right after this, okay, if we knew this was coming. Or if we didn't know it was coming and right after it happened, we should definitely sell. Does that make sense?
It wouldn't wait.
What?
Rerun.
Well,
Depending on there's no right.
we're trying to talk about it somewhat theoretical but also practical.
Right.
Okay, theoretically, you're sort of making the assumption, okay, it's on the downhill spiral, okay? Granted, I'm making up numbers. I'm just trying to illustrate the concept of, because you've got to have some sort of a tool to be able to kind of say, all right, how long do we hold on to this thing before we get rid of it? And all you're really trying to say is, we want to make sure that before we get rid of it, that it doesn't really have the potential to make us the amount of money. In other words, think about, like, just to put it in even simpler terms. You work for somebody. You always need to be earning them more money than you're costing them. Otherwise, you're probably not going to have a job. Same concept here. If there's some sort of a minimum threshold that you've got to meet, and that minimum threshold is the 15%, if you don't meet that year in and year out, you're gone as a project. Okay? It's all performance-based. Because the idea is that I can sell off this asset now, take potentially, if there are any losses associated with it, take them now, but pour it into a new project that hopefully is going to be a much better performer above and beyond the 15%. Does that make sense? Okay. Everybody else? All right. All right. Now, one of the things that you're going to do, and once again, kind of put the numbers to this, is you're going to have to look at this as an owner, kind of that sort of decision point, that sort of decision rule. And so another way of kind of getting at the same sort of thing is to basically use all of your after-tax cash flow numbers to calculate a rate of return, and then to see if that rate of return sort of meets your hurdle rate and kind of go down that path. So let's just work through an example, what I'm talking about. So assume these are going to be all after-tax cash flow. Now, I cannot stress this enough. Can't. When you're dealing with the decisions of renovation, I've already said this before, when you're dealing with renovation decisions, disposition decisions, almost always, you are pretty much exclusively looking at after-tax cash flows. Okay? Now, anytime that you are typically looking at disposition, renovation decisions, you are almost always exclusively looking at after-tax cash flows. Whenever you are looking at acquisition decisions, in many cases you're looking at that on a before-tax cash flow or an operating income sort of approach. Okay? But for disposition and renovation decisions, it's almost always on an after-tax cash flow basis. Okay. So, let's say that we've got a property. We have a basis of from an after-tax basis of $100,000, and over the course of the next several years, on an after-tax basis, we're generating $10,000. Okay. And then at the end of all of this, we could sell the property on an after-tax basis for $150,000. Okay, all of this is on an after-tax basis. All right. So first thing I want you to do is just calculate what is the return here. Okay, just on those cash flows. It's going to be your internal rate of return. It's going to be 1 penny per year. And on this one, yeah, you can shortcut it a couple different ways. It doesn't matter. Whatever you got to do to make it work for you. I get 1711. Okay, are we matching up?
Mm-hmm.
All right. Now, so what we're going to do is we're going to say, all right, the existing owner is going to now project, what their cash flows are going to be through year 10. Okay? And then we're going to also do the same thing for a purchaser. Now, for our purposes, what we're going to be doing is we're simply going to be saying, oops, we're going to be putting in, kind of having the owner, to a certain extent, almost treat this as if it was basically a sale of $150,000 at the end of year 5. Okay? All right? And once again, all this is after-tax cash flows. So you're simply just taking that number, depositing it up there. All right? And you're going to make the assumption
You don't have the 10,000 for the year?
No. Okay, so let's take those cash flows, calculate the IRR. I'll explain the method of the madness here in a minute. Okay, everybody good? All right. So now, we've got our purchaser over here. And what we gotta sort of determine is, all right, at what price are they buying this from the owner, okay, at time period 5? Because here we're sort of making the assumption from the owner's perspective, the property's gonna be worth $150,000 at this particular point in time if they were to sell it. So we can put that in, if we will. As a purchaser's point of view. But,
No, give me my answer.
but, what we're probably going to want to do here is incorporate other things this owner, this new owner, the purchaser, might be doing to the property. Because the expectation is they're probably going to put in some additional tenant improvements, okay, to maybe upgrade the property somewhat. All right.
So if the 150 was after tax cash flow, meaning the purchaser actually putting in more.
We can put in more. That's
No, I just,
I mean, we can do that. That's a fair question. Let's put in 180. Okay. So all in, the new purchaser is going to pay, let's say, $180,000, and that is going to be basically their total investment. All right. But from that, they're going to get a higher
So the 180 includes those improvements?
Sure.
I'm assuming that.
Yep. Okay, and let's calculate their rate of return. Okay. So the new owner, by virtue of what they're able to do to the property, they're maybe able to get a slightly higher rate of return than the previous owner because of putting in a little bit of extra money up front, but also getting a little bit more on the operating cash flows as well as on the resale price. Now, here is the part though that from the existing owner's perspective, we want to kind of evaluate. Assuming that the existing owner once again, has a hurdle rate or reinvestment rate of 15%. What should they do? Sell it. Because they determined after this first 5 years of operations, they're meeting and exceeding that hurdle rate. Yes? But they're projecting the next 5 years to have these cash flows and this sort of a rate of return with respect to the resale of only 7.8%. So that's substantially below their hurdle rate of 15%. So automatically, yes, they should sell.
Question. But it's not, I mean, in the example, yes, but technically it's not costing them 150,000 because they were young. So I don't
They're
know.
foregoing the purchase price. Okay. They're foregoing the 150,000.
What's for going?
They know they could get that, but instead they're choosing not to.
It's like someone saying, okay, after 5 years, we know we can sell it for 150,000, and if we basically walk away from that, what have we walked away from? So that's what this analysis sort of takes into place. See, quite frankly, yeah, if we were to just continue with this series of cash flows, you would say, oh, yeah, you should probably hold on to it. Because you're probably going to get something greater than 15%, but because this is the period at which we can actually sell it, then we're able to sort of take that into consideration in our subsequent analysis.
So we're kind of assuming what the future sale of that value
Well,
is.
you are to a certain extent. Okay, you're basically performing this analysis right here.
Correct.
Okay, so it's not really future in that sense. This is future. But you know you can get the 150
Correct.
right here, right now, today.
Right.
So we can lock that number in, and that shows us what a return is here.
But that doesn't tell us that it'd be beneficial to sell it here next year or not, because we don't know the actual selling price of the.
We don't know precisely
Right.
what it may sell for subsequent to that. If we did in each and every year, we could then go back and just simply apply our little marginal rate of return. Okay? This is sort of taking it in kind of a lumpy form, so to speak. And just simply saying, we're going to make these sort of decisions once every 5 years. Okay? And we're going to reevaluate it once every 5 years, which is probably not that uncommon. You know, in one sense that while you're constantly evaluating your portfolio, I mean, you also don't want to have a bunch of knee-jerk reactions to what may be going on or not going on in the economy. You want to try to be somewhat thoughtful as to what is anticipated to happen. Is this a short-term phenomenon? Is it a long-term phenomenon? You know, what's driving it? You know, those sorts of things. Okay, make sense?
So they're just going, where their IRR is 17.11.
Yep.
Five, okay, now, they're just going out, extending it out, prediction for another
Yes.
5 years.
Yes, for themselves.
For themselves, right.
Okay, and
Looking
then-
at market conditions.
Right, and then what we're doing is that we're taking it a step further and saying, okay, if we're coming in as a new purchaser under these conditions, with what we're having to pay them, plus maybe some renovation cost thrown in, knowing we're gonna get a little bit of extra rent as it relates to that, and we can maybe sell it for a nice little bump up at the end, then that's gonna be our rate of return. So, yeah, we're gonna be able to technically perform a little bit better than these guys, but this sort of analysis is endless, because we could then say, well, these guys could have spent a little bit of extra money, renovated it, and, you know, seen what the ripple effect would be. I mean, that's what I'm saying, you can look at this from so many different angles, but we're trying to isolate each owner, each action. Okay, make sense?
The way we, if somebody offers you something, Carlos, at 150 that day, that year, and you don't buy it, sell it, you bought it at 150, if you think about it that way. So then it goes into the next, you see what I'm saying, because you didn't sell.
Okay.
Yeah, you're Carlos, right? Chris, I'm sorry, Chris.
I
Yeah.
was like,
Does that make sense? Because you bought it, because you didn't sell it. You still own it, and you didn't take the funds. So,
I mean, you know,
that's the way I think.
personally, one of the best situations I ever had, in from an investment point of view, I bought an old bank building that I paid, I think it was $262,000 for, in a small downtown, and literally 3 weeks after I bought it, I had an offer for $70,000 more than I paid for it, never even touched it. You know, and so it was just like an instant, boom, take it, move, you know. And don't even do that project because this is kind of like, why not take that extra working capital and put it into something that I can not have any brain damage on? Question?
I was just gonna say, if you look at it like if you were to hold it, the more cash flows there are, all things equal, the IRR would drop, so it would actually, 'cause I just did that on here, so if you go out to year 10, keeping that all equal, the IRR drops below the hurdle rate. So you kind of see that it's a better choice than that.
Yeah, I mean, quite frankly, what we should do, put this into Excel and say, for each year, here is not only the operating cash flow, but for each year, here is what we can sell it for. Calculate that marginal rate of return, calculate a running internal rate of return, and then you could, you know, then see that nice little sort of inflection point. Okay, make sense? Okay, moving forward.
And what we just did, what would you, like call that, if I'm titling my chapters as I go?
I mean, you just simply, you're looking at after-tax rates of return for a disposition versus holding decision. Okay. Now, what are installment sale contracts? Assuming that you want to maybe sell an asset, but you don't necessarily want to incur all of the capital gain now, and you want to be able to spread it out over a longer period of time, you might use an installment sale contract. What it basically means, in retail terms, it's kind of like layaway, okay? It's the whole idea that you have a property that maybe either you're occupying or that you're interested in buying, and you could almost view it as rent to own. You could view it as maybe a contract for deed. You could, you know, there's a variety of different ways this can be viewed as to what it actually is and how it sort of manifests. But the typical sort of situation is that maybe you have an existing owner of a property, and they own the property free and clear, and maybe they've owned it for many years, and they're saying, you know, I'm tired of managing this property on a day-to-day basis. Tired of paying the property taxes and the insurance and dealing with maintenance and repairs and all that other sort of stuff that goes along with the property management side. And so they say maybe to one of their tenants, hey, you want to buy this building from me? tenant says, sure, but I don't have a whole lot of money, and maybe my credit is not all that great, and you know, a whole number of other things, all right? But they've been a great tenant. They've been in the building maybe for 10 years. Pay your rent, always on time. And so what you're basically doing is saying, okay, you're going to be turning over, to a certain extent, the management and the operation of that building to them. Now, there are other tenants in the building, maybe 4 or 5 other tenants. So now they're going to go from obviously paying their rent every month to collecting the rent from the other tenants, taking care of the property taxes, taking care of the insurance, taking care of the maintenance, taking care of anything and everything that happens with the property. But instead of going and getting a traditional loan and selling the property through a broker or whatever, however else you might choose to do so, you simply engage in a one-on-one scenario with this tenant, with the owner.
So seller finance.
It is, but it has some caveats, okay? And so one of the caveats is because it's this installment sale, you're not going to give them the title of the property or the deed to the property until that last payment has been made. Okay? Does that make sense? So this relationship could be 30 years. Could be 15 years, 5 years, 10 years, doesn't really matter. But the point being is, you know, let's say, all right, let's say we've got a property that's a $1 million property. Let's kind of do the math here. Now, what I may be able to do is if I were to sell this property, okay, yeah, I can sell for $1 million as the owner. Pocket the cash, pay my capital gains, call it a day, put that $1 million in the bank, be done. Yes? Okay, but by doing this, I can engage in a 30-year, we're going to assume 12 payments per year, and we're not necessarily going to have to require a down payment. We're just going to make the assumption that they're going to continue to make these payments to me for the next 30 years. All right? And let's say the interest rate I charge, I don't know, let's just say 7%. Do that right? 653 will do? Yeah. Okay. Now, so what that means is that for the next 30 years, I as the owner am going to be receiving a check in the mail for $6,600. All of that, I don't have to deal with, you know, they're going to take care of the property taxes. They're going to take care of the insurance, utilities, maintenance, everything that has to be done on the property is now their responsibility. Now, at the end of the 30 years, then I will transfer title to that person. Now, if for whatever reason they are delinquent, they skip a payment, whatever, depending on state law, that sort of thing, Texas is a little bit different than here in Florida, but in Texas, pretty much, I can just say, deal's off, don't have to go through a formal foreclosure process. I can take possession of the property back and start fresh with somebody else. Does that make sense? Okay? Now, why would I do this as the owner, and why would the tenant potentially do this as the purchaser? So let's talk about the kind of the pros and the cons. Ken?
As an owner, you're getting a 7% return without all the work and the headaches.
Yes, because here's the missing piece about this that you just sort of, you don't really even think about. Am I getting $1 million for this property?
Yeah.
No, I'm getting a heck of a lot more because I'm getting paid over the next 30 years interest. So instead of just taking $1 million and basically taking that money, plopping it into a bank account for the next 30 years, I'm getting 665302 times 360 months. I'm getting $2,395,088 as the total cash in to me. Does that make sense? Yep.
And it's good for the tenant in a way, because if he doesn't have a lot of cash and can't come up with, like, for example, 25% down payment or whatever, he can use this as a way to kind of become an owner of the building.
Right.
It's making an assumption that you have no debt.
Correct.
And the guy lives with it.
You can't do it if you have debt.
Right.
Right?
What, is Tommy over here? What,
But what happens if he dies? Like a year
who dies?
The guy who the
The
guy
guy's
who
gonna put a hit on his back.
well, just for example, the tenant that decides to buy.
The tenant dies?
Yeah, for example,
I keep pointing at Ken as the tenant. But seriously, no. But, okay, if the tenant dies, what happens?
yes, in 15 years.
If their heirs don't take over the payments, I take repossession.
So everything that the guy paid is back.
Right,
This is by Texas law?
right.
That's if he doesn't pay, it's foreclosure. So it's
I need to go to
self-funded.
Texas.
So what happens if?
Well, the difference between traditional seller financing is that if you take out a mortgage, you would actually get title.
Okay. So in this case, it's a whole thing.
This is going to get you through the whole foreclosure process. Whereas with this, with the contract for deed,
This is like a rent to own.
that's what I said earlier. Yeah, yeah, it's very much like a rent-to-own situation that at the end of it, you get possession. Or you get not just possession, but you get full complete ownership.
So in this scenario, you don't have to go through the formal foreclosure process or anything?
Correct.
No, because you already are, you're still technically the owner for the deed.
Okay.
Right.
What happens if it's reversed, if
If I die, okay, if I die, then basically it's upon my heirs, whoever they may be, to potentially enforce the contract and continue to collect the money. Now, chances are, what could happen is that that could trigger, well, maybe, a formal sale of the property. And if that were to occur, then potentially, they could maybe potentially still continue to be a tenant under the future owner, or, depending on how the relationship is set up, but more than likely, it's gonna be a situation where the relationship will be able to continue because we have a contract.
because I wouldn't wanna do that and then
Right.
something happens to you and all of a sudden like I made all those payments and.
How would you sort of take into consideration the time value of money? Because who's to say that 2 million, throughout 30 years in value is less than taking $1 million 30 years prior?
Well, because it depends on what your reinvestment rate is. In this case, we're basically saying our reinvestment rate is 7%,
Okay.
and we're happy with that.
Okay.
But there are other, and that's where I was kind of going with this, other benefits in the sense that when you do this, you take your gain month by month, year by year, in terms of your capital gain, and it becomes as a percentage of the overall dollar amount you're selling it for. So, without getting too persnickety with respect to this, if I, as the owner, had bought the property several years prior for $500,000, and I sell it for $1 million, we don't consider the interest as a capital gain, okay? It's going to be simply ordinary income. So the only piece that's going to be the capital gain is half of the principal payment. So technically, in this case, let's just say we've done all of this, and then we go and we say, all right, over the first 12 months,
Principal is 10,158.
the end of the first year of this situation, on my income taxes, what I, in essence, we're gonna have to do is to say, okay, how much do they actually pay me back? Okay, in terms of the principal repayment. They paid me $10,158.09. But how much of that is capital gain? Well, if I bought it for $500,000 and I'm selling it for $1 million, then basically trade did it purposely. Half of this would be capital gain. The other half is just recouping of my original investment. Does that make sense? So on my income tax, 10,158.09 divided by 2, $5,079 would be the capital gain that I would be taxed on for that year. Okay? Versus if I had a clean transaction of just, I bought it for 500, I sold it for $1 million, I would have $500,000, okay, 100 times this amount as my capital gain that I would have to pay taxes on immediately.
Yeah.
So this allows me to defer my capital gains and spread them out over the next 30 years. And to create a nice little annuity for me, is basically you can sort of think of it as like a retirement annuity. Does that make sense?
Yeah. This might be a stupid question, but I've never had any sort of capital gain. In that instance, would the tax be sort of taken out of check, similar like a paycheck, or
No.
something you do
No.
in your taxes?
You do, this is where, I think, when you go to file your income tax each year,
Yeah.
you're gonna fill, I think it's a Schedule D, Schedule E, whatever it is. You probably know right off the top of your head. Okay?
No, I'm not.
But the point being is you're gonna fill out the schedule that's gonna basically, it's gonna be installment sale contract, and this is the dollar amount that I bought it for, this is the amount that I sold it for, this is the amount, or the period in which it's being financed over, here's the portion that is the capital gain for that year. And so each and every year, I'm gonna have to calculate, what is this amount, what is this amount, and put that on my tax form.
Up until the,
Counts.
Sorry?
up until the point when you fully pay the gap, that happens.
Right.
Once that's done,
Well, at the end of 30 years.
but then you're paying,
No. Here's the point. I understand what you're asking. Because what you're basically saying is that as fast as I get back this principal, all of that should be subject to capital gains. No. What we're saying is we're only having to pay a proportional amount of this each year. It's not like that for the first, let's say, whatever, 15 years that we're paying capital gains, and then we have no capital gains from year 15 to 30 because we've already paid off, no, that's not the way it works. The way it works is we're paying off a proportion of the capital gain each and every year for the next 30 years. So you're simply deferring it out into the future. Okay? Well, this is great for those folks that may not want to completely give up ownership of the property initially, and at the same time, still draw on the cash flow. Yep,
And you were saying the interest received is taxed as ordinary income?
correct.
Okay.
Just like, I mean, it would just be basically like any other, interest you could receive. Actually, your ordinary capital, or not, your ordinary income tax rate. Okay? Now, to complicate this up a little bit, not too much, but just a little bit, you could have given me a down payment, okay, or some equity, just to show some level of good faith and that sort of thing. It may not have been as much as what might have been, under a traditional loan, but you might have given me, 10%. Okay? Whereas going to a normal bank, you might have had to come up with 25%. You follow?
Yeah.
All right? So we could add that, and we could sort of say that, on top of this deal, you could have had the $1 million amount of the sale price, but you maybe had, in addition to that, given me, 10% of that, or maybe $100,000 as a down payment. So added to that, maybe on top of that, is what I'm saying. So that maybe your total purchase price really was $1,100,000. I'm just adding to the complexity of it. Okay, just simply saying you could have had that. Okay. Now another piece of this. I'm trying to think. You could theoretically, as part of this package, you actually brought the question, could you do this prior to, if you didn't own the property free and clear? Well, you could, but what might have to happen is they would have to potentially assume your existing loan.
If it's transferred.
If it's transferable. Okay? So, this is, instead of complicating this, we'll just start with a new one just for a second, just to illustrate my point. So we could have had a situation of where maybe there's an existing loan of, okay, give me a dollar amount. Okay, an existing loan of $1 million, all right? We have a down payment of, let's say, $200,000, and then you're going to make payments $5,000 a month for 10 years. Oops. Okay, so it's a brand new problem, set up a little bit differently, okay? So you've got an existing loan that you're going to assume, that existing loan of $1 million, you're going to put in a down payment of $200,000, and you're going to make principal payments of $5,000 a month for 10 years. And that's going to be the installment sale contract. Now, if I work with those particular specifics, if I were to ask you, what is the total purchase price of the property? No. Well, I'm sorry, what did you say it was? No.
5 times 12 times.
Well, you gotta figure out what your principal payments are.
Oh, okay.
So 120 months,
600,000.
so 600,000 plus 200,000 plus 1 million, all of that would be the total. Okay? Does that make sense? Okay, it's another way of structuring it. Now, one of the things I didn't quite go into here is we didn't quite finish up on some of the motivations. Okay, we talked about that you might get a lower down payment than you would with a traditional lender, but what else do you not necessarily have to do as a purchaser in this kind of installment sale sort of transaction?
Get points.
Yeah, there's no loan fees. There's no appraisal required. You might still want to do one, but if you feel comfortable that the value of the building is what we're saying it is, okay, no appraisal. What else? Don't need to necessarily do a survey. No commissions. Okay? So, right there, you're alleviating a whole bunch of brain damage for him as the purchaser, and to a certain extent, me as the owner of the property. I mean, I know what it's worth. I know what, ultimately the survey is going to tell me. I know what the appraisal is going to tell me, but yet we're not being required to have to pay for any of that, so transactional costs are substantially less for this kind of a transaction than it would be under ordinary circumstances. Another you know, sort of, I guess, way of looking at this is I might even be able to charge a higher interest rate than the traditional lender, because I'm basically alleviating you of having to put in a larger down payment and having to pay for all this other stuff. You follow? Okay, thoughts? Good, bad?
Question that just would sound odd. Okay, if you put in 200,000 down payment, what is that? The existing loan would be 800,000 remaining? Or this is just like?
This is a brand new problem.
Okay.
So here we're just saying, yeah, we've got an existing loan that's $1 million. We're going to require a down payment of 200,000, and we're going to have these principal payments of 600,000 in total. So the total purchase price all in is going to be 1.28 million. Now, the one thing we are purposely leaving out, this does not include interest. Strictly the purchase payments. Okay? All right. All good with that? Yes? What is the section 1031 tax deferred exchange, and why do we need to know that?
So you can save money.
So you can save income taxes. Okay? What is it? What does it allow you to do?
Move the debt, like property. Move the debt to another property.
Okay. Anybody else? Just think what all of you are going to say.
Another property.
Okay, one more time.
Roll over proceeds.
Okay, roll over proceeds to another property.
Profits into another property, so you don't pay taxes later.
Okay, so the whole idea here is to do and the key word is deferred, not tax-free exchange. Many times you'll hear people talk about these as tax-free exchanges. No, they're not tax-free. They're tax-deferred. At some point, you're potentially going to have to pay, you know, the tax on it, but you're being able to defer it indefinitely. So you can think of it as being free, but the reality is it's deferred. Okay, now here's what it boils down to. You buy a property, you own that property for several years, commercial property, all right, and you decide, okay, it's time to sell. So you sell it, and so kind of like in one of our previous examples, you bought it for $500,000, you're selling it for $1 million, and that is going to translate into a $500,000 taxable capital gain. Okay, that is then going to be taxed at whatever the going capital gains tax rate is at that particular moment in history. Okay, now that doesn't mean we're going to be paying $500,000 in taxes. It simply means that we would have a taxable capital gain of that. So if our if our actual capital gains tax rate is what?
15?
It depends on how long you've held it and a whole number of other things, but let's just go with 20%. Okay, so if we did choose at the time of the sale to just go ahead and pay the income taxes payable on that capital gain, maybe $100,000 of actual hard cash money out of our pocket into the pockets of the IRS. Okay? Does that make sense? Yes or no? Now, we being mildly sophisticated investors are saying, we really don't want to have to pay $100,000 of taxes on the sale of this asset, because what we're actually going to be doing is we're not going to be taking this money and going out and buying a boat, or going out and, you know, spending it on a big vacation, or, you know, somehow to enhance our personal lifestyle. What we're actually going to be doing with this, we're just going to be plowing all of this back into more property. Okay? So if that's indeed what we are doing, is that we are taking every dollar from the sale and we are plowing it into a brand new income producing property to us, that allows us to forego having to pay this capital gain. Does that make sense? Now, if in any way, shape, form, or fashion we touch that money personally, like for example, we can concoct a gazillion different scenarios, but I want to make sure how weirdly obsessive the IRS is with this, okay? Let's say that we do this sale, and, you know, between me and Paul, so I'm selling this property, you know, to Paul for $1 million. He is, in essence, let's say, writing me a check for $1 million. I take that $1 million check, and let's say I put it into my bank account, and then I go to Vegas, take some of that money, gamble it at Vegas, take and put back the full $1 million, but keep, you know, some of the winnings over here to the side. Right there, I've already screwed up. Okay? Because first of all, I touched the money. Okay? What actually has to happen, and this is the part that is obsessive, you have to have a third party involved in this. Typically it's going to be a title company. And so the check that Paul writes goes into a special account that I have no control over, no access to, can't touch it with a 10-foot pole, and it sits there, okay, in an escrow account. And it sits there until I am ready to find my new property that I'm buying from Diego. Okay? And once I've selected that property and I've negotiated and am ready to buy from him, then what actually happens is the money's not coming from me, it's coming from that escrow account directly to him. Or now, if he's doing another 1031, it's going to be going to yet another third party, kind of, this whole process is just a big shell game. But the point being is it's going from basically the escrow account to him. It never ever touches my hands. Okay, does that make sense? Now, within this process, there are all kinds of really fascinating little nitpicky details of you were given a very specified, and I'm trying to remember, I think it's 45 days or, I'm sorry?
45 days.
45 days
To identify the other property.
to identify a property that I want to purchase, okay? If I wait until the 46th day to do that, deal's off. I gotta pay my taxes, okay? It's hard cold, okay? Those of you that have had Professor San Miguel for a class, and you know he has an accounting background, and you know that if you turn something in 1 minute late, it's not accepted. Well, the IRS is very much the same way, okay? And so the point being is that in essence, you've got to actually conform with each of these steps along the way in order to qualify for this tax deferred exchange. And if you miss any one of those steps that the IRS has set up for you, the deal is off, you gotta pay your taxes. Does that make sense? Now, my advice, you're not gonna become 1031 exchange specialist overnight. It's one of those sorts of things that you need to be aware of this. And if you're in a situation where you know you're gonna be selling a property that you own and immediately taking those proceeds, putting them into another income-producing property, you probably need to do a 1031 exchange. And you need to talk to someone that can walk you through the very specific mechanics of accomplishing that, because it can save you a very substantial amount of capital gains tax.
Would that person be a lawyer or an accountant?
Usually it's going to be an accountant or somebody that has done a whole bunch of these on behalf of a title company, but most title companies are populated by lawyers and accountants. So
There are companies that do 1031 exchanges.
yeah,
They're
that's all they do.
just agents for 1031s.
There's a whole cottage industry set up around them because it's a very, you know, it's just a very specific recipe that you've got to follow. And if you deviate in one small granular detail off of that recipe, deal's off. And because here's, and you're saying, okay, why? And all right, the IRS, they want tax money. Congress put together these set of guidelines to allow for this sort of an exchange to happen without having to pay tax liability. That doesn't mean that the IRS is going to help you to achieve this no tax liability. They're simply following the guidelines that have been set by Congress relative to compliance.
So 1031 exchanges, technically, would the details change and say a new tax plan?
Yes.
Put into place?
Yes. But reason it's called 1031, that is the section of the Internal Revenue Code that it refers to. Okay, that's the reason for, say, 1031 exchange. Where does the 1031 come from? At the time of the day, is it the day it was passed? Is, no, it's a section of the IRS code that it refers to. Yep.
Okay, so in the normal course of business, how does that actually, how does an investor, you know, play the 1031 exchange? Because I would venture to say that you sell your property, and identifying another property that suits you, that has the cap rates, that has the cash flow, in order to, and then having a seller that is willing to sell it to you in 45 days. 45 days is pretty amazing.
You can identify up to 3. They allow you to pick 3.
The thing is, it does push you into a position, either you act or not act, and it can't make you make a bad deal.
Yep.
Exactly, that's what I'm thinking.
No,
So is it,
here's, without getting into all of the,
how do they usually do it? The people that do it, how do they do it?
give me a second to try to give you a perspective. Okay. Whenever these things were first set up, 1031 exchanges, the rules were pretty damn loose, okay? And over the years, they've been tightened to where they are not easy to do, okay? Originally, you were given, I think it was like 6 months to identify a property. And to identify a property, you could go so far as to simply literally say, okay, here's a phone book with every single property in Miami-Dade County. That's sufficient,
Right.
okay? But over time, the IRS has said, okay, that's kind of silly. You know, let's tighten the screws on this and get it to a point of where we're forcing people to take action in a very short time horizon. We're forcing them to kind of say up front, whenever they decide to sell a property, they pretty much need to have their next piece of property picked out, that this doesn't need to be this ongoing kind of, this money sits in this account for the next, you know, couple of years.
Right.
Okay? Because previously, the laws were even looser. You know, it wasn't just the 45 days, but you also had like a couple of years to finally close on the deal.
Right now, you're 60 days, 45 days,
Yeah,
it's like 60 days to close.
So my point is, it is not the IRS's job to make this easy for you. That's not what they're trying to do. They are just simply saying, we're trying to comply with whatever guidelines that we have been given. And if you don't comply with these guidelines, you're not going to get the deal.
There's a brokerage out there, I forgot the name of it, but all they do is market 1031, and there's people going up and down the scale too, because they rather take a little bit of loss on the way down and kind of defer the payment. So, and you know, one of the things I always appreciate is that, you know, you lose your buying power, you know, because if I have 500,000, that gives me a lot more buying power than 400,000.
Right.
And, you know, I just wait to cash out, and, you know, you go up, and then you start coming back down, and you play the tax game, so.
I think the new property you're investing in is equal to or greater than
Yeah, and that's another piece that complicates this. I was trying to avoid having to go down all those different paths, but yes, if you have a situation of where the new property is worth less than $1 million, then, like, let's say the new purchase price is 900 grand, then that means that you've got $100,000 of what they call boot, B-O-O-T. And that boot would then be taxed proportionally to your capital gain. So in this case, with a $500,000 capital gain and a $100,000 boot, then that means that in essence, half of that dollar amount, basically $50,000, would be taxed as a capital gain. Okay? Now, there's also, very simply put, you are exchanging technically one income producing property for another income producing property. This is not a situation of where your personal residence and selling it for another personal residence, anything like that, or trading it for, you know, going from an office building to a personal residence. You can change property type, but it still needs to be an income producing property. So you can go from an office building to a shopping center or to an industrial building, you know, that sort of thing. That can change. There's no issue with that, okay? But there are other things that can complicate the deal. Like, for example, you're buying the property, and let's say that it's got a whole bunch of equipment that you're buying as well that's not a fixture to the property, okay? You know, and if you've learned in your law class, or you will learn in your law class what fixtures are, it's something that's been permanently attached to the property and is included as part of the real property, okay? Well, there's a reason for that legal distinction, because in the event that you buy a property, and let's say that this has got, let's use this, tables and chairs, okay? This would all be considered to be personal property, but yet it was included in the sale. Well, technically, that is not part of the real property. Therefore, it would have to, you'd have to find out what the market value of the tables and chairs are, subtract them from the overall value of the property, and you could get into a situation there of where all of that stuff combined would, once again, reduce the overall value of the property you're acquiring. So, I mean, there's all kinds of little nuances with this. You know, same thing, like, you could view farmland as income producing property, okay? But yet you look at ranch land's different. Because the animals on the ranch land, those are not part of the land, but the crops are. Mm-hmm. So, you know, trading a farm for a ranch is not the same thing. There's all kinds of weird little complexities of this that you could just dive into for days, you know. But the key thing that you, as an investor, developer, redeveloper, whatever, need to know is simply, if you're wanting to basically sell a property and take the proceeds and invest in a new property, you probably ought to look at this. That's really all I'm trying to say, okay? Yeah.
Can you split the gain? Can you say, I'll pay taxes on 100,000
Yes.
and defer 400?
Yes. Well, depending on how, and it could, because it can also be multiple properties. In other words, it could be a situation of where you're selling off, let's say, 3 properties here, and maybe you're acquiring 1, or you're acquiring 5. You know, whatever it might be, all of those, that's not the issue. The issue is just simply figuring out to make sure that whatever you're acquiring is hopefully of equal or greater value than what you're selling.
I was just thinking on the scenario where you have a gain of 500,000, and you say, I'm going to take 100 of those and go on vacation and defer the 400 and pay taxes on the 100.
Yes, you can do that, but you're going to pay the
remaining.
Yeah.
Yeah. Yeah, you pay $20,000 on taxes.
Yeah. Okay. All right. Move on. All right. things that is available to you from a renovation perspective are income tax credits. Specifically, if you're renovating historical structures, okay? Or structures that have been designated somehow like in a historic district, or they're of a certain age or older, okay? And the way that this works, first of all, you probably need to know the difference between a tax credit versus a tax deduction, okay? If I offered you a $1,000 tax credit or a $1,000 tax deduction, it was one or the other, not knowing anything else, which one should you take? The tax credit, because it's worth more.
It's 100%.
Yeah, because a tax credit, and this is something, write this down. A tax credit is a dollar for dollar reduction in income tax payable. A tax credit is a dollar for dollar reduction in income taxes payable. So what that means is at the end of the year, you've gone through, you've done all your calculations, and you've gotten down to your income taxes payable are $5,000, let's say. And I come in and I say, all right, I'm going to give you an income tax credit of $5,000. What that means is now you're going to owe $0 to the IRS because it's a dollar for dollar reduction in your income taxes payable. Does that make sense, everybody? Yes or no? Whereas a tax deduction is a dollar for dollar reduction in your taxable income. One more time. A tax deduction is a dollar for dollar, excuse me, dollar for dollar reduction in your taxable income. So, if you remember, we had net operating income minus annual debt service gave us before tax cash flow, and then we subtracted out income taxes payable, and that gave us after tax cash flow. Oops, right, all right. But to get this income taxes payable, what do we have to do? We had to take net operating income, subtract out interest expense, subtract out amortization points, okay, and that gave us taxable income. Times the tax rate, marginal tax rate, which gave us our income okay? So I went back in over here. Okay, does that make sense? Remember that. Now, so let's just sort of take a look, if we sort of flow down, where, in essence, would a tax deduction come from? In other words, where would it go? Okay, it's going to potentially go up here, although in some cases tax deductions may come out of your operating expenses, okay, in the sense that you've got effective gross income, you subtract out total operating expenses. Many deductions may just come out of operating expenses, but there also may simply be, in this case, these are examples of tax
Deductions.
deductions, okay? Because each of these reduces your taxable income, as does a deduction you take out up here under total operating expenses, because it will all flow through, okay? Do I cool with that, yes or no? Whereas for a tax credit, what you're basically saying is, once you've gone through all of this, then we're able to say minus tax credit to come up now with your FX cash flow. Does that make sense? Okay.
Like,
No, plus tax credit.
I'm sorry?
Plus tax credit.
What?
Plus? Isn't that plus? You're
Well,
adding.
okay.
Tax
All I'm
credit.
really saying is, okay, you get it applied here is what I'm saying. You
Okay.
apply the tax credit, whatever it is, to your income taxes payable.
Okay.
All right, now, so, the point is the government has tried to incentivize a number of things over the years with tax credits and tax deductions. You know, for years, you know, for home ownership, they gave you a nice big, you know, mortgage interest tax deduction, which is still there. They've limited it, they've changed it up a little bit. They've changed the standardized deduction, which makes it less valuable. But the point being is, it's still there in one form or another as a tax deduction. But other things have emerged over time as tax credits that the government has tried to encourage. Two things specifically as it relates to real estate are renovating historic properties and providing low-income housing tax credits, okay? So that there are incentives to you as a developer slash investor in low-income housing or workforce housing that will give you basically tax relief for constructing those properties. Does that make sense? Now, the historic tax credits were meant to be an incentive to you as a developer with the context, we don't want to tear down our history. We don't want to tear down buildings that were built, you know, in the 1800s or the early 1900s that may have some significant architectural details and that sort of thing, just to make way for a brand new glass-covered mall or office building, okay? And so the federal government decided, all right, let's offer up some incentives to developers and investors to say, if you will go through a number of steps to try to save as much as you possibly can on the exteriors of these buildings and on the interiors of these buildings, we're going to give you up to potentially a 10 or 20% tax credit on the renovation cost. Okay, does that make sense? Now, the specific details, basically for properties, and this just has to do whenever the property placed into service prior to 1936, automatically will get a 10% tax credit if you renovate it. Now, why is it 1936? Anybody just want to take a quick gander? I'm not going to play this game for very long, but it's just kind of a
Depression.
no.
Was there a tax change?
Yes. What year?
1935.
No.
1936.
30?
1933.
No. Okay. What's probably one of the most major significant tax law changes that has been made in the past 50 years was made in 1986. Okay? Well, 1986 minus 1936 is 50 years. So he basically said, properties at that point in time that were 50 years and older, we're going to allow you to automatically get a income tax credit. And so that date is just stuck. And so 1936 has been, even though we're obviously 30 odd years past that now, you know, it doesn't move, is my point, okay? So 1936 is when all good things, you know, sort of cease to happen, so to speak, I guess, from a historic perspective. And so prior to 1936, you automatically get a 10% tax credit, okay? Does that make sense? Okay? Or do you understand? There's a difference between understanding and does it make sense. Okay. All right. The other one is properties that are certified historical structures get a 20% tax credit. Now this is determined by basically a combination of your state historic society, your state historical societies, as well as the federal government, where they may designate an individual house, an individual building, structure, whatever it might be, as a certified historic structure. Or one of the things that they are known to do to kind of speed up the process and make it a bit more inclusive is they will take a specific geographic area on a map and draw basically a circle around it and say, okay, all of these structures within this mapped area are going to be part of a certified historical district. Therefore, they are all going to be eligible for a 20% tax credit in the event that they choose to do renovations on those properties. Does that make sense?
And is that just a one-time use, or is it like a duration of years that you can?
My understanding is, yes, you can sort of do it over and over, but it's going to be applied to whatever the cost of those renovations were at that point in time.
Who's getting the credit? Is it the person doing it?
Okay, now you're getting into another element of it.
I'm trying to visualize it.
No.
Usually it's the four buildings are owned by a government, so I'm trying to.
No, normally what is happening is, well, I say normally, but the developer slash investor slash owner, whenever they go through, they do their renovations. At the completion of all of that, then in essence, when they file their income taxes for that bigger project, then they are going to get back basically a check or certainly a reduction in their income taxes payable as a result of having done those renovations. However, the reason he's laughing is because there's a whole other market involved in this where you can have investors that buy tax credits. Okay? And there's a whole market of either high net worth individuals or corporations where they will give you a certain percentage of the overall value, maybe that's a little bit more than what you would get, or sometimes maybe a little bit less, depending on how quickly they give you the money. It's kind of like, it's one of those, it's the same sort of thing like you winning the lottery. All right? They may give you all the money up front, but the benefit is going to be over maybe several years. And that's a whole other element of this that, once again, you could spend hours and days talking about all the different little nuances that exist there. The big picture of what you need to be familiar with, once again, is simply these exist. So, to the point that you're going to be looking at any sort of historic structures, or properties built before 1936, you need to be aware that, yes, there are some tax benefits that you can receive on the renovation of those. Now, with that, there are always strings attached, in the sense they're going to hold you to some very specific guidelines of things that you may be saying, I don't want to keep that, or I don't want to change this, or I don't want to do this. But you may be forced to if you want to get that tax credit. Okay? And then the same sort of thing on the low-income housing tax credit, very much, a situation of where you've got to provide maybe a certain number of units or a certain percentage of your units to be occupied by a certain threshold of the median income. And that will then, once again, give you potentially a federal low-income housing tax credit. But, having just said that, a lot of state governments and local governments will step into that process as well and say, we will give you maybe not only sort of an income tax credit, but we'll maybe give you a property tax credit of saying that if you do this renovation for low-income housing or for a specific group, then there may be some sort of other tangential benefit that we will offer up to you. Well, that may or may not be all that beneficial depending on whether you're a nonprofit developer or a developer for profit. Okay, you want to talk to that for a couple of seconds?
No, I don't really get into all that,
Okay.
so.
No.
Because the way our structure is, it's very simplified versus the guys that build the big
Right.
towers, and those guys are experts.
Right. I mean, once again, it's a whole industry. And if you really get into this and you really are fascinated by the financial details of how this applies to developers and investors, literally you can set up shop and just be a consultant to provide these services, because it's not easy. There's a lot of very devilish details. Okay? All right. Other questions? Okay.
I have a question about the previous section, back to the 1031. That only applies to investors, not to dealers, right? So if you're rehabbing property or building property constantly, can you take the proceeds or part of the proceeds and put it in a 1031 exchange and really start your next project?
Sort of.
Okay.
What you mean by dealer is that you're constantly flipping properties, okay? Well, the IRS treats that different than they do investors.
Right.
Investors are typically defined as they own the property for 2 or more years, okay? Flippers, something less than that, okay? And so if you're a flipper, typically you're not really paying just capital gains tax, you're paying more of a normal
Income tax.
operating income tax. Because what's really happening is you're saying, okay, I'm selling this property, I'm buying this property, I'm selling this property, I'm buying this property, and it's like boom, 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 boom. It's like a chain, but also basically it's like a mill. I mean, you're just churning one run after another, after another, after another, after another. And the IRS basically is looking at that as that is more of an operating business than it being more of a passive investor business. Because with an investor, the assumption, I mean, your tax rate is lower if you are doing this as an investor and holding on to the properties for 2 or more years, whereas if you're doing it as an operating business where you're, building, developing, flipping, in under 2 years, then you're going to be taxable virtually all that income as ordinary income, as opposed to taxable capital gains. Okay.
Developers who build and then sell, they're considered dealers.
Right. Unless the time horizon is long enough to kind of consider themselves to be investors. And once again, it's another one of those nuanced little things of you wanting to be classified as one versus the other. Because there are advantages to one versus the other. Okay, once again, tax advantages. Okay, other questions? All right. I think we've got maybe 1 or 2 minor little things. Yeah, I'll finish those up next class session for this chapter. All right, so let's do this. Take a quick break, come back, and we'll do test number 1.
So my company, my partner, he buys an apartment building in Fort Myers, like 04, 05. He buys it for $8 million, he 1031 the money, the profits from another deal. So he buys so Tarragon, a big hedge fund in New York, in 06, says, hey, we'll give you 30, well, we started at 22, and my partner drove the price to $30 million. So we're gonna make $22 million in 2 years. Right? No, these are the guys that work with super, and they don't do all these calculations and stuff, it's common sense, however. So now he's got to identify another property. So we're looking at these 3,000 acres on 95 in Jacksonville. And this guy, his name is Octorok. He's an engineer, owned the property 30 years, bought it for like $2 million, 30 years. So he's old, he wants to retire, he's cashing out. And it's the perfect time, right? There was 5 suitors, most of them more sophisticated than us. That's the key. More sophisticated than us. 50% of the land there is wetlands, 50% is not. So 1,500 acres is really usable. So all that being said, it's got the zoning, it's got the future land use, all that's good. So it's 50 million, but we have 30 million. So we go to the bank, they're coming by every day. Take money, we'll give you interest reserve. So we take the 30 million plus the 20 million, and we buy the property in 06. Now it's land. It doesn't pay dividends. There's no income. So the interest at 6% on $20 million a month is real money. That's real money. So it's a 3-year deal. You know, the banks only give it to you. So then here comes the crash. So instead of paying the income tax on 30 million and putting 20 million in your pocket, plus or minus, and having the rest of your life to do whatever you want to do, he stops paying the in principle, I mean the payments. Yeah. So Regions comes and says, hey, we're going to foreclose on you. But he has assets all over the place in his name. So then he starts putting all of his stuff in his wife's account. Because, as we're learning in law class,
you can only do that for the home.
No, you can do it in anything. You can't take it back, that's why doctors do it.
Okay.
So he makes his wife a partner now.
Okay.
So anyway, but there's a clawback if the attorneys figure it out. So all that being said, he lost his $30 million plus $1 million in attorney's fees. He lost his $30 million. So, wow. So when you're forced to do that 1031, you really got to say, hey, do I want to keep my 20 million and be safe and do it in another? It's a really funny thing because he lost $30 million. That's real American money. The bank ended up with it, and he still, through the recession, he still made a ton of money because he's smart, but he lost that particular property. And when it was so painful, that was painful. No, 30, because that he could have put 20 and never had to work it. He still got way more than that. Right. And this guy is Cuban born, I'm not Cuban born, from Hialeah. Right. I don't want to say that. Hialeah, that only has a high school, but smart, super smart, and tough as nails. And he reads every contract, even if the attorney does. And he's made all that money back again in the last 4 years. Wow. Yeah. But the 1031 thing could be good and bad.
Of course, yeah, that's what I was thinking. It's a challenge.
And an example of the where you bought the property at 150,000.
Right.
We had a property in Pembroke Pines that I bought for 5. I could have sold for 9 in 1 year. In 1 year, and he's like, no, the same guy. That's not enough. It's worth 11. No 6. I'm like, so we don't sell it. So I said, well, you just bought it for $9 million.